Hi, everyone. Welcome. Thank you so much for being here to the VIN Foundation Climbing Mount Debt Student Loan Triage in the Age of COVID. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and we're thrilled to have you with us tonight. I'm here to give you a couple housekeeping bits and pieces of tips. So there's myself, and then we also have Dr. Paul Payan and Dr. Matt Holland on, and we're all going to be here helping to answer questions and make sure that this runs as smoothly as possible. We have a Q&A section at the bottom of your screen. Please use that for any of your questions. Please do not use the chat window. It makes it very hard for us to track which questions have been answered. And please put any questions that you have in that Q&A window. And we also have the opportunity there to upvote any questions that you might have. So if you see a question that you feel is important and one that you want answered as well, just upvote that and that'll be bumped up to highest priority. We will try to get through all the questions during the webinar at different points during the webinar that are relevant. And if not, at the end of the webinar. This webinar will be recorded and you will be receiving an email within the next couple days with the recording of this webinar along with helpful information and links. If you have questions, you can always email studentdebt@vinfoundation.org. And our goal is to be here to help you, and we hope this provides you with some helpful information in these very uncertain times. A couple other points to note, all of you are automatically muted. That's the way that it works with Zoom. And the Q&A is there for you for any questions. And if there's any other questions, just let us know. Thank you so much for being here and I hope that you be well. And I'm going to introduce Dr. Tony Bartels. He is our speaker and a lot of people know him as the debt doctor, and he's going to provide us with hopefully a lot of information that will give you some answers in this uncertain and unsure time. So welcome, Tony. Thanks so much for being here.
Yeah, thank you, Jordan. Thank you, Matt and Paul as well for helping with some of the facilitation tonight and for setting this up. And thanks to everybody who registered and submitted some comments and questions ahead of time. I do have some of those that we will get into, but we did have more than 1,000 people registered. So we're not gonna be able to get through every question that was submitted. So I did pull out a sample of them. There was a lot of themes that definitely came to the surface. So we will definitely address some of those major themes, and then please feel free to ask questions along the way. And we'll try to answer those either during the topic that question pertains to or at the end of the material. So there's been a lot, and I can sense it just in the emails that I get and the comments that you submitted, that there's a lot of anxiety around some of the changes to student loans due to the coronavirus legislation. So the CARES Act that was recently passed, rightfully so. I mean, a lot of this stuff was done very quickly, and there were some pretty major changes. And we don't usually see major changes to loans that are already in repayment. So this is quite new for a lot of reasons, student loans just being one minor of those. So hopefully everybody is as healthy as can be expected, and maybe your incomes haven't been affected too much yet, but even if they have, that's kind of why we're doing this, and we want to provide some guidance on what you can expect, and maybe provide some bridges as we work through this pandemic and all the health and economic consequences that are going to fall out as a result of it. So first is going to be a poll. So we do have some polls. It helps me know who you are a little bit, and as well as guide some of the discussion tonight. So you'll see some polls pop up. I haven't released it just yet, but the first one is going to be related to COVID-19. So I'm going to launch that here, and you should see a poll on your screen, and please answer the appropriate response that fits you best. And you may see me kind of looking, I've got two different screens going on here. So I'm using the second screen to know when the polls are done. right, looks we've almost got 70, 73, 74% of the people responded so far. All right, I'm going to end this poll here and share the results with you. So it looks like the winning response, or the highest proportion, was yes, I'm working less, right? So this matches the anxiety and some of the questions that I've been seeing when it comes to student loans and some of the changes to these programs. All right, so we're going to come back to the presentation here and dive into some of the material. So what do we know? On March 13th, the president announced a student loan interest waiver. So that was more of an executive action, if you will. The week after that, the president announced an administrative forbearance option. That was one that you actually had to request to have your payment reduced or set to zero. And then on March 27th, Congress passed and the president signed what is now known as the CARES Act, right? And this is a series of coronavirus legislation designed to help small businesses, individuals, student loan borrowers, a whole host of things. So the student loan portion of it that we're focusing on tonight is covered under that CARES Act. And that's good because the law provides a little bit more guidance and concrete information to work from than the presidential directives do. So what is in the CARES Act? So there are two major sections that deal with the student loan repayment in this new law, and that specifically is suspension of payments, right? So you are not required to make a payment during the suspension. No interest is going to accrue, and that's going to last through September 30th, 2020. Any payment that you would have made during that time would be considered towards forgiveness or rehabilitation. So that's a really important point that they laid out in the CARES Act. So for those of us that are using income-driven repayment and we're working towards a forgiveness clock, or if you're in default and you're working through a specified rehabilitation, this suspension period counting towards those clocks is a huge provision that they spelled out in there. If your loans are in default, they also have suspended any involuntary collections related to that default of your student loans. There is no action required for you on this, right? So, and I think that's where some of the confusion started when the president came out and waived the interest. The interest rates were set to zero automatically, but you had to actually request the presidential administrative forbearance. But when the law passed, they actually decided to do this automatically. So if you have eligible student loans, and we'll get into that in a second, but if you have eligible student loans, this suspension is going to happen automatically. So if you're in repayment, the payment will stop, the interest rate will be set to zero, and your auto pay will be turned off. Right, so all of that stuff is in the process of happening automatically. For some of you, it may have already happened. I'll show you an example. I have Great Lakes, and it has already happened for my student loans. Right, so I didn't have to do anything. They just turned off my payments. They set my interest rate to zero, and they turned my auto pay off. There is also a second provision in there regarding employer contributions, right? So this has been something that's become more popular over the last few years. But one of the hangups with employer contributions to student loan payments is that they were not tax deductible. So in this legislation, they are making employer contributions to student loans, to employees' student loans, up to $5,250 tax deductible for this tax year. So it is spelled out specifically for January 1st through December 31st for 2020 only. So what is a federally held loan? If you have a federally held or federally owned student loan, that's what is going to suspend the interest payment and any collections if you're in default. Federally held loans is a little confusing, right? So this is why knowing the types of loans you have really, really important. We're going to go through how you can dig through that. And one of the tools, the free tools available in the VIN Foundation Student Debt Center is really good at doing this. So all direct loans, if you know that you have all direct loans, all of those will qualify for this suspension. Direct loans are all federally held loans. The confusion comes in with the older Federal Family Education Loan Program loans, so FEL program loans. Those are no longer available. You haven't been able to get those since 2010, but they might be federally held, but they might not be. The same applies to Perkins loans. Health profession student loans, loans for disadvantaged students, another type of federal student loan, but those do not qualify. They are not federally held, right? They're usually held by your school or some other entity. And private loans also do not qualify under this current legislation. I do have a second poll for you all, so I'm going to send that out. And this has to do with your student loan portfolio. And so you should be seeing that one coming out in a second. All right. So if you know what type of student loans you have already, then you can already know if this has impacted you or will impact you. And if not, we're going to go through an example of how you can find this information out. I'm wondering can you all see the poll? I'm only seeing one person responded so far.
If some of you guys are having any issues with the polls, if you, it might be on a pop-up window that's behind your current screen. So there's been a lot of updates to Zoom lately with everybody working from home. So I would take a look behind the current Zoom window and see if you can find the poll window there. We will also be having all the poll results included in the webinar recording that you'll be getting a copy of.
Because I still haven't seen anybody else respond. I'm going to end this one. I'm going to try it again. So let's relaunch that one. All right, now I see some more people. Looks like they found it. So. Scan some of the questions here while we're waiting for the polls to come in. Yeah, and so there is one question here regarding this, and so one person asked, my student loan was supposed to be auto debited today, but I have seen nothing taken out yet. Should I be paying now? So no, if you already have auto debit set up, then if your loan servicer hasn't enacted the suspension for your loans yet, then that payment would automatically happen, or maybe they have already suspended your loans and they're canceling that automatic payment, in which case you wouldn't have to do anything. All right, let me end this poll here and we'll share the results here. It looks like the majority of you have only direct loans, but we do see a smattering of 20% of you or so have some mixture of the loans that we mentioned. 1% of you have only private student loans, and then we have a mixture of private and federal. And then we'll show you again how you can wade through this information and maybe provide some more certainty there. All right, so let's come back to our presentation. So who is the loan owner? So the first place you may want to start is your loan servicer. But every loan servicer reports this information a little differently, right? So I tend to not spend too much time on the loan servicer website when I'm looking for information like that. I will say that Navient actually has a pretty good area where you can look for and find the owner of your student loans. I can demonstrate that, because I have a small portion of my balance with Navient, and they are also a FEL type of loan that does not qualify for this suspension. So let's come over to the Navient website, and I'll log in here. These are my loans that I keep mostly for research and development purposes, so I can keep an eye on what Navient's telling people and when I hear the information that they give out to folks. So if I click on my loan details and any of these ones that have a balance that's greater than 0, I can look and see who the loan owner is. So current owner, I see Navient Federal Loan Trust, right? So this is not a federally held or federally owned loan. So this is why I am not receiving a 0% interest rate and my payment has not been suspended on this particular loan, right? What you're looking for in here, the current owner is to say Department of Education, right? That any loan that says Department of Education is going to qualify for the suspension. One alternative to this is to retrieve your My Student Loans or your federal student aid data file. So if I come over to the student aid website, so everything runs through studentaid.gov now. So this is another new change that was completely unrelated to the coronavirus stuff, but this has happened fairly recently, where almost everything that you do with student loans now goes through the studentaid.gov portal. So I'm going to log in here and show you what I'm looking for. All right, so we used to counsel people on retrieving what was called the National Student Loan Data System file. And the NSLDS website has been taken down and now everything runs through here. So here's my total student loan balance, right? So that Navient one that I had is just a fraction of my student loans. The majority of my student loans are from veterinary school and the bulk of them reside with Great Lakes. And you can see here that Department of Ed is in front of there. So I know that that's a federally held student loan. But if I want to get my file and look a little bit more closely at this, I click on that view details, and there's a link in here when you're on a laptop or a desktop that says download my aid data. So if you click this download my aid data, it's going to save what we call the NSLDS file or my student data text, right? It's this ugly looking text file. That's the one you want. So I will save this one to my folder. Actually, let me make sure that's, give it a new name. I think I've downloaded this a dozen times in the last couple of days, just looking at it. Right, now I can come back to the VIN Foundation Student Debt Center, and we have a My Student Loans tool where you can upload that file. Right, I know this seems like a lot, but the National Student Loan Data System file, that text file that I just downloaded, is really the gold standard, right? So this is it's the most consistent source of information that everybody else is working from, right? So the $1.5 trillion of student loans that the Department of Education monitors is all kept track of in that system. And that text file is a little slice of the student loans that I own as a part of that huge balance. Right, so I'm going to go look for that file that I just downloaded. I'm going to upload it into the My Student Loans tool, and it's going to give me a breakdown of all the important pieces of information that I'm going to need to make decisions about my student loans, including who owns them, right? If they're a federally held student loans. And this is nice because now I get to look at my Navient and my Great Lakes loans together, right? So I can see in one place the different loan servicers and owners that I have. This is a new feature that we just rolled out a couple of weeks ago. We're reporting to you your anniversary dates. We're going to come back to anniversary dates when it comes to income-driven repayment. You can see, and some of you actually had this exact same question. If you're in your renewal period now, what do you do, right? So I ran up against this exact same thing, right? So my payment was due to update next month. And now I hit the suspension period, right? So I had already submitted all of my annual income documentation for renewal, and they're just holding on to that, right? Because the suspension has pretty much interrupted all of that process. So I am due to renew. I have submitted that paperwork. I can see here that I have two different loan servicers. Again, this is where I'm looking for, Department of Ed, right? If I see Department of Ed before the name of the loan servicer, then I know that that is a federally held loan. Right, so that's the type of loans that's going to qualify for the payment and interest suspension that is laid out in the CARES Act. I can also see that my Navient loans here do not have Department of Ed in front of them, right? So that matches what I saw on the Navient website. So I know that those are not going to receive that interest and payment suspension. And before you guys all run and use Repay because I'm using Repay because my wife and I don't qualify for pay as you earn, right? So the other benefit of putting your loans into this tool is so you can see exactly which income-driven repayment plans that you qualify for, right? Revised pay as you earn is the next best plan for us. But if we did qualify for pay as you earn, we would be using that plan. All right, so we're gonna come back to here. So we took a look. All right, so which repayment plan are you using? Right, so this is gonna help me know how much of this information is pertinent from the income-driven repayment standpoint. So you all should see a poll. And if you don't know, again, you can, you grab that file from the studentaid.gov, download it, upload it into the VIN Foundation My Student Loans. You'll see which repayment plan that you're on. The information in the National Student Loan Data System has not been updated with any of this suspension stuff yet, right? So there's not any kind of forbearance or anything listed in those files. It just kind of lists what your loans were doing as at the end of the month, or if they've been immediately updated. It'll be a snapshot of what happened before all this. All right, so we got almost. See some people are still replying. Give me another few seconds here. All right. So I'll share those results. It looks like 62% of you are using an income-driven plan. About 14% of you are using a time-driven plan. And it looks like we've got some students here in school and grace period. So great. So this is some good pertinent information, right? So the income-driven plans are really the ones that are, I would say, uniquely impacted by the suspension. And that's what we're going to get into next. All right. So kind of like the poll alluded to, we do have two major ways that we can pay back our student loans, right? So there's either a time-driven option or there's an income-driven repayment option. So the time-driven options are more of our traditional repayment methods. So those are based on the principal, the interest rate, and then the time that you choose or you're assigned to pay back a particular loan, right? So a standard 10-year plan is an example of a time-driven repayment plan. Based on what you borrowed and the interest rate that you borrowed those funds at, they're going to calculate a payment required to pay that loan to zero over a 10-year time period or 120 monthly payments. The monthly payment is a fixed cost. You know it's going to be. There's no unpaid interest, right? So you're making payments that at least cover the interest and some of the principal each month. There's well-defined costs in these plans. That's why people like them, right? They know how long they're going to be in repayment. They also know how much it's going to cost them in total, presuming they can continue making those payments for the duration of the time frame. We also have these income-driven plans, and that's pay-as-you-earn, revised pay-as-you-earn, income-based repayment. These are also the plans that people who are working towards public service loan forgiveness use, right? So these are very different. They all have unique eligibility requirements. So we already covered a piece of that with my loans, right? So my wife and I are using revised pay-as-you-earn, but that's because we don't qualify for pay-as-you-earn, right? So you want to see first if you are eligible to use a plan like pay-as-you-earn, because it's usually really beneficial. There are certain exceptions to that, but it's still nice to know which ones you're able to use before you choose one. Your monthly payment is a percentage of your income, right? So they're income-driven plans. As the name implies, the payment is a percentage of your income. So if your income goes up, your payment will go up. If your income goes down, then your payment will go down, right? You can't have what's called unpaid interest, and many of you probably have unpaid interest. I have unpaid interest, right? So you can, when you're using income-driven repayment, you can quite often have a payment that is less than the interest that accrues each month, which means that you are accruing an unpaid interest balance, right? So that's not part of the principal. It's separate from the principal. You only accrue interest on the principal amount. The unpaid interest is separate from the principal, and the unpaid interest doesn't cost you any additional interest as long as it doesn't get capitalized. And we're going to talk more about that in a little bit. These plans do tend to drive people crazy though, and it's because they have variable cost structures, right? You know, 20, 25 years, who knows what your income is going to do, right? We're kind of seeing a sample of what can happen now, right? So for those of you that said you're working less, you're probably earning less, right? So now your incomes are going down. We had been seeing incomes going up for a number of years in veterinary medicine, and now the whole world is really kind of experiencing an economic slowdown. So what is that going to do to my long-term repayment costs, right? Those are the things that are really hard to figure out. But we do have tools like the VIN Foundation Student Loan Repayment Simulator where we can put things like this in there and see what that does to our long-term repayment. We also use some metrics to help us determine whether it makes sense to use a time-driven repayment approach or an income-driven repayment approach. The most reliable one, after running thousands and thousands of simulations, is the debt to income ratio, right? So we can figure out our debt to income ratio by taking our student debt balance and our income, right? So I'm going to be asking you to provide your student debt balances and incomes, and we'll do our debt to income ratio as well. You didn't think you were going to be getting homework here. Here comes another poll. And we're looking for ballparks here. You don't have to get it down to the penny, but if you know it down to the penny, even better. Thanks everyone for answering quickly. Wow, that's impressive. All right, I haven't seen it changed. I'm going to share these results. We got a pretty good normal distribution here, right? So it looks like the majority of us are in that $200,000 to $300,000 range. We do have, yeah, it's actually a pretty normal distribution. I don't see any non-student debt folks here, which makes a lot of sense. Okay, and then the other part of this equation is your income, right? So that's where we're going to hit the next part of this equation. So this is your current taxable income, right? So try to account for any slowdown that it may have hit your paycheck or you anticipate hitting your paycheck when you get the next one. Again, ballpark estimates here.
Tony, somebody's asking, where were you able to click to get the My Data file on the student aid website once you're logged in? I think they missed that part.
Yeah, let me go back to there while you're answering that poll. Or actually, I'll have to wait until I close the poll so you can see my screen again. All right, so I'm going to end this one here, and we can share those results to you too. So again, we've got a pretty normal distribution there. So most of us falling kind of in that middle range, somewhere between 70 and 110,000. And then based on the student debt total there, I mean, you know, again, just macro look at this. I'm looking at a student debt to income ratio that's probably 2-ish, right? So, but we're going to get to that question next. So this is all part of that, figuring out what our student debt to income ratio is. But before we go and do that, I'm going to come back and answer the question that Jordan relayed on. So when you're in the student aid website, so let me go back to my dashboard. There's a couple of different ways that you can do this. So when you log in to the student aid website, you're going to log in using the same information that you use to apply for your student loans, or one that you're going to set up so you can get in here that's based on your social security number. I'm going to hit view details. And when I'm in the details section, I'm going to have a link in the right-hand corner of the screen that says download my aid data. Now, if you're trying to do this on a phone, you're not going to find this link. We have discovered that the mobile version of this website doesn't provide a way for you to download your text file. So you're going to want to do this on some kind of non-mobile device, most likely, so you can have access to this download my aid data link. All right. So debt to income ratio. So I know I'm kind of doing a lot of polls here, but this will be the last one for a little while. So put the two together, right? So take your student debt number that you reported, divide it by your income, and choose your debt to income ratio number. And then we're going to put all this together, and we'll do a quick sanity check to see if you should be using income driven repayment or pursuing more of a time driven repayment approach. So almost up to our 75% or so voting. All right. Thank you again for contributing to those polls. So here are the results of that. And we can see a distribution of debt to income ratio. More than half of you reported that you're greater than 2, or that you have no income. Right, so that's going to be a new situation right here. So with the COVID related effects. So let me stop sharing those, and this is what we tend to see. Again, when you run a lot of these simulations, there's themes that arise, and one of the biggest themes is if your debt to income ratio is greater than 2, right? So your debt exceeds your income by more than 2 times. You should be using an income-driven repayment. Hopefully pay as you earn if you're eligible. Sometimes that doesn't apply, but those are pretty specific cases. But for the most part, you want to be using an income-driven repayment plan, paying the minimum, planning for the forgiveness, the tax that's going to hit at the end. You want to reassess that every year, particularly if your income is changing, like we're in kind of this uncertain period now. And in terms of the suspension, enjoy the suspension, right? This is really why this has been put in place. The suspension is a really drastic measure. And that's because we're having some really drastic effects based on this pandemic. When your debt to income ratio is between 1 and 2, it really depends. Depends on if you're heading more towards 1, if you're heading more towards 2, and where are you in the time frame of repayment. So if this is, within a first couple of years after you've graduated and your debt to income ratio is approaching 1, then, income-driven repayment can be helpful as you're getting started, but then you're probably going to be benefiting from a more time-based approach. But if you're kind of in between 1 and 2 and, it's not really going to dip below 1, then you're still in that area where you want to be using income-driven repayment, paying the minimum, planning for the possible forgiveness. Depends on what your income does in the future. But this is another case where you would want to enjoy this suspension, right? So if you're, again, the strategy when you're using income-driven repayment is to pay the minimum and plan for any forgiveness. When the government gives you an option to pay nothing, then pay nothing, right? That's what I mean by enjoy the suspension. If your debt to income ratio is less than 1, right? So we had about 10% of the folks who indicated that that's the case for them. That's great, right? You're likely to pay your loans off before you hit any kind of forgiveness. You can use income-driven repayment if you want. It's completely optional. You can use a traditional repayment plan, right? This is when a standard 10-year plan or sometimes even a private refinance makes sense. But if your loans are still in the federal system and are eligible for the suspension, I really wouldn't be looking to refinance them right now because your interest rate is 0, right? So it's you're not gonna be able to refinance at a lower interest rate than 0. So maybe after the suspension, you might look at refinancing, but this might be an opportunity to put an even bigger dent in your loans if your finances allow for it. But if your income has also taken a hit, then you may want to enjoy the suspension as well. It's okay to not pay something towards your student loans during the suspension. That's why it's in place, right? Is to give you that cash flow flexibility to meet those other expenses that you may have a hard time meeting when your income isn't the same as what it was.
Tony, somebody's asking, is it a good idea to make payments to take advantage of the zero interest period and pay down the principal?
Yeah, so that was one of the common questions that came up, and it really depends. Again, if your debt to income ratio is in a range where you should be using income driven repayment, paying the minimum and planning for the forgiveness, then it does not make sense to pay more, right? You're really just wasting that money. If your debt to income ratio is less than 1, and maybe you're using a time driven plan and you can put a dent in the principal, then sure, it's a good opportunity to put a dent in the principal as long as you don't have any unpaid interest and you're relatively certain that your income isn't going to take a hit from this pandemic outbreak, which is really hard for anybody to say, right? These are really, really uncertain times. If you have an opportunity to reduce one of your major household expenses, like a student loan payment, to zero and not have any interest accrue during that and not have any negative consequences after that, take advantage of that, right? You may need those funds, right? You may not need them right now, and maybe you're feeling like you're working even more, but that situation may not hold, right? So we really don't know what's going to happen, and you really want to hold on to more flexibility than voluntarily hand over funds that you may need later. So what if I'm during this suspension, I'm using an income driven repayment plan and my income has decreased, right? So for whatever reason, whether you're furloughed, maybe you're on sick leave, or you had to stay home and to watch a child who, because school's closed, or whatever the case is, accept the suspension, right? I mean, it happened automatically. I have gotten some emails from folks already that said that they didn't ask for it, so they canceled it really quickly. I mean, you can do that, right? You can opt out of the suspension. It will be applied automatically, but you should really accept that suspension. You can also request a refund of any payments that your loan servicer has taken, maybe if you had auto pay set up, that go back as far as March 13th, right? So if there was a payment that was triggered from March 13th to now, or even in the future, you can request to have that payment refunded as part of the presidential directive. I would be, redirecting these funds to cover other expenses, right? I mean, and even if you don't need them yet, I might stash that payment that I was making towards my student loans in a separate account and reserve those for just in case, right? Maybe it's going to boost my emergency fund. Maybe it's going to boost my forgiveness fund if I haven't really started that, right? So I would hold on to that money and request those refunds, particularly if you need it, that have happened for those payments that may have triggered after March 13th. And also, so this gets back to the, what if you're in your renewal period, or if you really have lost your income, you can submit to have your payment lowered. And now they may not process it completely yet, right? Because it's the suspension, you don't have a payment due anyway, you don't have any interest accruing, but you can still submit that income documentation. And then as the suspension ends, they'll check back in with you to see if you want to submit income documentation again, or do you want to use the income documentation that you've previously submitted. And so I mentioned annual renewal dates before. So if you're using an income driven repayment plan, normally what happens is you have to provide annual documentation of that income at least each year, right? So if your income's just kind of going up from year to year as it was before we hit this situation, then usually you submit like a pay stub or you submit a tax return and they adjust your payment accordingly, right? So that's what happens during normal non-pandemic times. Your adjusted gross income from your tax return is the easiest way to provide this information because you can do it electronically. But now during this time, right, so we've had this automatic suspension of interest and payments. If you're using income-driven repayment, the suspension period, so if you were in repayment under an income-driven plan prior to the suspension taking effect, you are still considered to be in income-driven repayment. So that time counts towards forgiveness. You don't have to make any payment and no interest is accruing. Right? So you can still apply to have the income, you can still submit your income documentation to have a payment lowered or maybe even knocked down all the way to zero, and they'll ask you if they want to process that, which means you're essentially foregoing the payment suspension, and your payment will be based on that income documentation. So based on the conversations I've had with my loan servicers recently, and my interpretation of what's been passed in the CARES Act, they're likely to hold on to that information, right? So they like I showed you before, I was in my renewal period, and I had submitted my income documentation, and they were ready and set to update my payment starting next month, right? So that will be what my payment will be once this suspension ends, presuming I don't send them something different in the interim, right? So they're holding on to that payment information. They're just not processing it fully unless I choose to opt out of the suspension, in which case they will then revert to whatever income documentation that they have on file, or whatever you owe them if you're in a renewal period. So if I'm using income-driven repayment, my payments are suspended, but my income has not changed and I can afford to pay more. So this is kind of the question that Jordan just relayed recently. First thing I want to look at is, do I have any unpaid interest, right? So that's where I'm going to come back and look at my student loans report, right? And are you likely to reach forgiveness, right? So here I'm going to come back to, we're going to come back to my report, right? So let's take a look at report for my loans, right? So I have some unpaid interest here, right? I am no longer accruing any interest on my student loans right now, right? My interest rate is set to 0. It doesn't show it here, but it's reflected on my Great Lakes site. Even if I were to make a payment during this suspension, anything I pay is going to first go towards this unpaid interest balance, right? There is no mechanism for you to bypass an unpaid interest balance to knock down the principal. I wish there was. Maybe we'll see that in some subsequent legislation, because that would be really helpful, right? But that's not what we currently are able to do, right? So it doesn't make any sense, particularly since my wife and I are counting on loan forgiveness, to pay any more than we have to during this suspension period, right? So since our payment is set to 0, we have no interest accruing, but the time still counts towards forgiveness. That's like a triple bonus when it comes to anybody who's using income-driven repayment, paying the minimum and planning for the forgiveness, right? So it does not make any sense if you have unpaid interest to make payments during the suspension, because you can't get to the principal first anyway. So use that My Student Loans tool, send some information over to the simulator, right? So how do I know if I'm going to hit forgiveness? So let me upload another example for that, right? And this one will be a little bit along the lines of some of the data that you all reported in the polling system tonight. So I have another sample that we can work through. This is somebody who graduated in 2019, so they've been out for a year, and they're not due to renew yet, but they're using pay as you earn, right? So that's a good choice. They're due to renew in October, right? So past where the suspension is projected to end. I see that this person has all federally held loans with Fed loan servicing. These are the plans that they're eligible for. But now I can take this information and send it over to the loan repayment simulator, right? So let's say that this person's been in repayment for a year under pay as you earn, right? And normally maybe their income is $87,000, right? And it had been kind of increasing, and now I expect it to maybe decrease by, I don't know, let's say a third, right? So let's knock a third off of there, right? I don't know what's going to happen the following year, right? So maybe I'll leave that alone. I'm going to leave some of the family information out of this for now. But if I run the simulation, and just based on what my anticipated adjustments are to the my simulation, I see that using pay as you earn, that I am set to hit forgiveness under this simulation, right? Which means that I should be paying the minimum in planning for that forgiveness. Now, what does it mean when I say planning for that forgiveness? We have a forgiveness planning module here. So here we are projecting about $454,000 forgiven and I have to assume a tax rate on that. You can change that to whatever you want, right? If you don't think that 30 is high enough, I think that's probably an overestimate, but you can put whatever you want in here, right? And this is going to show me how much I need to allocate to cover that forgiveness on a monthly basis if that happens 19 years from now and I haven't saved anything yet, right? So this person would need to, in addition to not paying anything during the suspension, right? So I'm going to take advantage of the suspension, and maybe after the suspension's over, I'm going to have a payment that's $300 a month or so based on my updated income, my reduced income from the pandemic effects. That means I also have to think about saving about $500 a month so I can start working towards covering that tax that's due at the end on forgiveness. Right. So we're not going to get too much into, specifics of forgiveness planning here. This is just so you can ballpark and answer the question, am I expected to hit forgiveness? Answer here is yes. Do I need to start planning for it, right? And how much would that be, right? So a better use of your funds in this case, if you had the ability to do so during this time, would be to plan for the forgiveness, not to pay towards anything towards the student loans.
Tony, a question just came in about something that you mentioned, which was they're asking for clarification. Are you saying that suspension of payments will count as a payment if one is in public service loan forgiveness?
Okay, so public service loan forgiveness is a little bit of a different beast, right? So public service loan forgiveness, you have to be using an income-driven repayment plan, right? But you also have to be working for an eligible 501c3 nonprofit state organization, right? So using income-driven repayment, making payments toward federal direct loans while working for the right organization. As long as you are making payments that qualified for public service loan forgiveness prior to the suspension, then that suspension time should count towards public service loan forgiveness. Now, we did have somebody ask a question, if you get laid off of your public service job, but you were working towards public service loan forgiveness prior to the suspension, will that still count? And that's going to depend on whether or not you get rehired by that public organization and continue so you can still average and meet the 30 hours per week that's required to meet that threshold for a qualifying public service loan forgiveness payment. Right? If you're still working for the public service organization, even during the suspension, then absolutely, even though the payment is suspended and the interest is suspended, it will count towards public service loan forgiveness. But if you are working and making public service loan forgiveness qualifying payments up until the suspension, and then you get laid off from that job, well, now you're not technically working for that public service organization anymore. So it's going to depend on whether or not you are rehired or you're able to obtain another position in public service to see if you can meet that 30-hour per week average threshold working for one of those organizations that is required for public service loan forgiveness. All right, so if you can afford to pay more, again, just take a deep breath, right? Pandemic equals uncertainty, right? These are some really, really uncertain times. And we really have no idea what to expect in terms of a fallout economically from this. So that means you want to really preserve any of the funds that you are able to preserve right now. So again, if you're able to pay more, take that amount that you are planning on paying and stick it in some kind of separate account, right? Create a special account, put it in an interest-bearing account. I know the interest isn't high right now, but put it in some kind of interest-bearing account. And then before the suspension ends, if you were to make it through all of this unscathed financially, then consider taking a chunk of that money and putting it towards whatever makes the most sense, right? I mean, you don't have to do it right now, right? If you don't have any payments due, you don't have any interest due, it's not going to be a secret when the suspension ends. If there was an opportunity for you to make a bulk payment towards your principal or something, you can do it right before the suspension ends and still take advantage of that 0% interest rate. But you do it knowing that you're in a more secure spot, right? Because they're probably not going to lift this suspension until we have some semblance of certainty in the economy, right? The whole reason that they're providing the suspension is because we don't know for how long or how much people are going to need to make ends meet, right? So take the strategy of banking that money now, and then, you know, if it makes sense to put it towards your loans towards the end of the suspension, then you can consider to do that then. It's just not the time to throw money at stuff that doesn't require a payment, right? You're going to have plenty of other bills that are in the essential and required category that will benefit from those student loan payment funds.
So I just want to take a quick moment. There's a few people here that are graduating in May of 2020 or within the next couple of months, and they all have questions about, you know, if we're set to start repayment after graduation, will this require action, and et cetera. We'll be doing a webinar for new graduates in about a month. But I don't know, Tony, if you just wanted to say anything.
Yeah, I do. And I noticed that is part of the registration, right? So the first and foremost, I mean, the triage part of this webinar is really to help the folks who are in repayment, right? And the ones who are graduating are kind of in a, you know, in a gray zone, right? Your clinics have largely ended, or you're finishing them up virtually, and, you know, you're going to be graduating soon. I do have some material towards the end here that we're going to get to that's specific for those who are graduating in 2020. But yes, we are going to do a new grad student loan playbook that's going to cover that group specifically, with plans to help them get those loans taken care of appropriately, even in light of all the COVID-19 changes. But I would say that just, you know, if you have any type of federally held loan, right? So the difference is when you're a student, you don't have a payment that's required anyway, but you do have interest that's accruing, right? And your interest has stopped. So as of March 13th, you are not accruing interest on your student loans, which is great, right? So, you know, there's really not much else to do with your student loans just yet until you officially graduate, and then you're able to try to get them into repayment. We'll talk about more about that in just a few. All right, so I'm working towards, I'm using income-driven repayment, and I'm working towards forgiveness. Again, the most financially beneficial strategy in that case is to pay the minimum and plan for the forgiveness. So you're saving something separate, dedicated towards the forgiveness. And I have a poll related to forgiveness and forgiveness planning, right? Because this is the one that keeps me up at night, right? And it's because, you know, the income-driven repayment is extremely beneficial, but it does require some discipline. And that, you know, it was hard enough as it was to get people to try to save for the forgiveness, but now we have this major interruption in our, you know, in the world, and that's going to affect our health and economics, and who knows for how long and what magnitude, right? So, you know, this is going to interrupt a lot of the forgiveness planning that I think a lot of people were kind of putting on the back burner. I don't see anybody responding to the poll. I'm going to try that again. So hopefully you're seeing the poll now. Thanks, Jeanette. She says she's not seeing it. All right, let me try it one more time. If not, we can abandon this one. How about now? Anybody seeing the poll now? All right, I see a couple people answering now. Cool. Yeah, I think we're stretching the limits of Zoom here. And while you guys are answering this, I see a question. This is a good question. So even though my loan says that I'm in forbearance, the time in forbearance will apply to forgiveness. That's correct, right? The loan servicers are calling this forbearance because that's the mechanism they have to put your student loans in this state. It drives me crazy. I'll show you when we log into my Great Lakes account. Mine says forbearance. It makes me sweat every time I see it. But this is a special kind of forbearance that doesn't result in a capitalization, right? So I wish they would say that on their websites, but they don't. They just call it forbearance, but I think it's because they're just all throwing this together and trying to make it work. All right, I'm going to end the poll there. All right, and share these results to you. So again, kind of as I've expected, right, or have seen in the past, I have not yet started, but I know that I need to start a plan, right? 30% of you. If your finances allow for it, right, and you're not economically impacted yet, and you are pretty certain you're going to hit forgiveness, then get started, right? The earlier you get started, the better, right? So before you start worrying about making extra payments towards your student loans while your interest rate is 0, start saving something for the forgiveness, right? Because that's going to be that, you know, that it seems like it's way off in the future, but it's going to sneak up on you before you know it. And the more time you have on your side, the easier it's going to be to meet that forgiveness target. But I will end my soapbox on that, and we will move on. Thanks for confirming that I should not be sleeping at night. All right, so bottom line, this suspension is hugely helpful, particularly if you're using income-driven repayment and planning on forgiveness, right? This is kind of the triple trifecta. No interest, no payment, but yet the time still counts, right? So it's almost like hitting the fast forward button on your student loans. You couldn't actually, when I read this as a proposal initially, I couldn't believe it. Like, it was almost too good to be true. And then they passed it like that, right? So from a financial standpoint, based on how income-driven repayment works, this is hugely beneficial, probably even more beneficial than some of the cancellation provisions that they were talking about, that many of you asked about too as part of your registration. So really, you know, take advantage of this, and then use it to, you know, address any financial needs that you have because of COVID-19. And then once you get past, hopefully, some of that financial interruption, you can use some of those funds to maybe start or boost that forgiveness plan as well. All right, I only have a couple polls left. This one has to do with your graduation year.
So Tony, a couple people are not able to see the results, so we might want to.
Oh, I don't. The last one that I did, I'm not able to. I'd have to relaunch the poll, and we'd have to recomplete it. So you'll have to. We'll have to pull that one out of the screenshots.
I wasn't able to get a screenshot,
okay.
Unfortunately, but we'll move along and continue.
Yeah. Yeah. For some reason, it seems like there's a delay in the polls actually showing up on your end when I hit the button. So. All right. Cool. I'm going to end this one. All right, Jordan, tell me if you can see this poll.
Yep.
Okay, great. So this one, so this gives me an idea of how many students we have, which is great. But it also, and what I'm looking at here is the likelihood. So when I asked for between 2012 and 2019, this gives me an idea of the likelihood of whether or not you qualify for pay as you earn, right? So if you fall in that bucket, which 53% of you do, there is a good chance that you qualify for pay as you earn, right? So the My Student Loans tool will tell you that for sure. The other bucket that I asked about, so the between 2000 and 2011, that's going to tell you, so the 25% of you that fall into that bucket, that's going to tell you whether or not you have those older FEL loans, those FEL program loans like I have, right? That small balance that I have from Navient, right? So that's the time period, and even before then, where those federal family education loans existed. So that's going to require a little bit of digging on your end to see if those are actually federally held or not federally held, right? So remember, the federally held loans are the only ones that qualify for the suspension of interest and payments. Doesn't mean that you can't still get them into the suspension and payment type of loan, right? But you would have to do a consolidation, which we're going to talk about in the next section. All right. So I have, let's say you have federal student loans, but you're not using income-driven repayment, right? So If your debt to income ratio is greater than 1, then consider using an income driven repayment plan, right? So that's when we do see them providing some benefits. Now is a good time to jump into them too, because you're still getting credit towards the forgiveness. Accept that suspension, bank and reassess. This is also, though, if you're not using an income-driven repayment plan, you're probably using a time-driven plan, which means you don't have unpaid interest, which means you can hit the principal if you make extra payments, particularly while you have a 0% interest rate, right? But in this case, I wouldn't rush to do that. I would save those finances in a separate account. And if you come through this financially unscathed, then you might consider making a boost payment right before the suspension ends, so you still hit the principal and minimize the amount of time and cost that you're in repayment. Right? But I would still take that bank it first strategy just in case you need those funds for some other purpose as we navigate this pandemic. If you have non-federally owned loans or private student loans, I have been poking around a little bit on these. Options are going to vary by lender and servicer. Some of them don't provide any options. But for example, if you have some FEL program loans owned by Navient, they are offering a 3-month deferment. Interest still accrues, right? So you don't get the federal benefit, the suspension benefit anyway, but interest still does accrue. They say that it's not going to capitalize, but if you were to put your loans in deferment after that, then they would take that unpaid interest and capitalize it. You really have to read the fine print on any of these non-federally owned or private student loans for any benefit that they're offering during this COVID-19. If you do have those FEL program loans, Perkins loans, HPSLs, or loans for disadvantaged students that are non-federally held, you can consolidate them, right? So if you consolidate them into a direct consolidation loan, they will now be a direct loan that is held by the Department of Education, and they would qualify for the suspension. The consolidation can take between 30 and 60 days, right? So there's going to be that time that it takes to do the consolidation. But once the consolidation completes, then you will be eligible for the 0% interest and the non-payment. You do have to be a little careful, particularly if you have the older FEL program loans and you're using income-based repayment, right? So the older FEL program loans, whether they were federally held or not, are eligible for income-based repayment, the 2009 version of that income-driven repayment plan. If you consolidate your loans, it will restart that clock, right? So you'll lose all of that time that you were working towards forgiveness potentially with those FEL loans if you consolidate those loans. So there's definitely a consideration to be made there, and it will capitalize any unpaid interest that you have with those loans, right? So it's not a no-brainer to consolidate them if you're already in repayment and working towards forgiveness using income-based repayment, right? So you would have to analyze that a little bit more closely using the VIN Foundation Student Loan Repayment Simulator to see how that would affect your long-term costs and the amount of time that you're in repayment. For these non-federally owned loans or private loans or refi, especially if you can find a loan with better terms, right? So if you have a non-beneficial or a really expensive private loan, now is a great time to try to refinance a crappy private loan with a better private loan, right? The interest rates are really low, again, presuming you haven't had too much interruption to your income and you don't anticipate, and you can find a bank that will believe you, then you might be able to get a pretty good refinance rate on a previously non-beneficial private loan. So to the consolidation point, right? So this is just a table to try to outline this. So only eligible federal student loans are covered by this CARES Act. So here we just lay it out. So direct loans are always federally held, right? So these FELs, maybe, it depends on who the owner is. Perkins, maybe, depends on who the owner is. HPSLs, LDS, definitely don't. Privates, definitely don't. But unlike the privates, the HPSL, the LDS, the Perkins loans, they're all eligible for a federal direct consolidation loan, right? So you can pursue that if it makes sense. I've talked several people through that, and in some instances, it can really make a difference. Okay, all right. So here we get to the pieces unique to the graduating 2020 students. So first off, congratulations. My apologies that the world went and kind of went to hell in a handbasket right before you graduated, but it will make you a stronger person on the other side. Enjoy this interest suspension, right? So you have racked up about as much debt as you can. You're knocking on the door of graduation, which means you're done borrowing for the most part, and they turned off the interest. That's great, right? Because your principal balance is really high right now. And if your interest rate is 0, you're not accruing any interest. That's excellent. Before you graduate, file a tax return. There's 2 reasons to do this. One of them is related to the stimulus checks that you may have heard of, right? So the only way that they're going to know whether or not they should be sending you a stimulus check is if you have a tax return on file that shows that you have income low enough to receive a stimulus check, right? If you've never filed a tax return before, as long as you're not a dependent on your parents' tax returns, if you file a tax return, then you should get one of these stimulus checks when they go out in a few weeks. You can voluntarily file a tax return, right? So even if you had no income during your 4th year, you can still voluntarily file a tax return. Jump on TurboTax or your robo-tax form of choice and figure out how to submit a tax return, and you should get one of these stimulus checks in the mail. Not only will you get one of those stimulus checks, you'll have a tax return on file that shows little or no income that you can use to make sure that your payment is 0 for the first 12 months after you graduate, right? Again, you're graduating into some very uncertain times. You want as much flexibility as you possibly can have, right? So having a $0 payment for at least the 12 months after you consolidate your loans is going to be hugely helpful, right? So file a tax return, you'll get the stimulus check. It'll make it easier for you to consolidate your loans and apply for an income-driven repayment. And then after graduation, this is the stuff we cover in the new grad playbook. We're going to do a 30-second version of it right here, right? You're going to want to start the federal direct consolidation loan immediately after you graduate, as soon as your loans allow. Many of you have already reached out to me trying to get your loans into repayment now because you have some time to do so. I applaud the eagerness, but you can't do that. Your loans are still stuck in this in-school status, right? Until you officially have graduated and your loans enter the grace period, you can't start that direct consolidation loan. Any payments that you make now on your student loans really aren't going to count towards anything, right? Again, because you're still kind of in this in-school status. The consolidation loan lets you end your grace period early. You can choose Fed loan servicing. They're all pretty terrible. Fed loan servicing has actually been pretty terrible in this suspension thing, but generally speaking, they have the most experience with income-driven repayment because they're the official monitor of public service loan forgiveness, right? So choose Fed loan servicing, apply for an income-driven repayment if your debt-to-income ratio is going to be greater than 1 after graduation. If you do that and you use your tax return that shows low or no income, then your payment will be 0 for the next 12 months, right? So the 0 and the suspension are essentially the same from a payment standpoint, but you'll get the interest suspension as well, right? So it doesn't really matter if you're in the suspension payment or a $0 payment, they're going to end up with the same thing. But you're going to want to watch for that end of the suspension closely to make sure that they're not going to require everybody to provide income documentation or something. We really just don't know what that's going to look like yet. But I still would recommend that you graduate, consolidate, end your grace period early, and apply for an income-driven repayment plan if your debt-to-income ratio is going to be greater than 1. Like Jordan mentioned, we will be doing an updated version of that new grad student loan playbook. We do have a copy of the one we did for 2019 graduates on the vinfoundation.org website. So if you're really eager to know how that works, you can review that one because the principles are still the same. The only thing that's different here is the stimulus check if you file that tax return, and then the interest suspension that you can benefit from or are already benefiting from. What about if you're graduating beyond 2020, right? Again, enjoy the interest suspension. This is kind of like the glory days of when your mentors went to veterinary school and they had subsidized loans, right? This is what it was like back then. This is a brief period, unfortunately, but again, enjoy that suspension. Next fall, more good news, sort of, right? I mean, your interest rates, presuming next fall resembles anything that looks like last fall, your interest rates on your student loans when this suspension ends are likely to be much, much lower than they've been in the last couple of years, right? So they're based on a 10-year treasury. The 10-year treasury is almost nothing, right? So when they add the 3.6% to it, if the suspension ends in September 30th when it's supposed to, and you start accruing interest on your student loans that you take next fall starting October 1st, that interest rate's probably going to be about 4.5% on a direct unsubsidized loan, which is almost 2% lower than it was previously. But we really don't know what school is going to look like next fall yet, right? So we kind of have to stay tuned. You know, that's why we really don't want to wade too far out into the future here. We're really just dealing with what we know and what's in front of us, because we're going to have to revisit this all again towards the end of the summer when we know the suspension is ending, or maybe the suspension is going to continue. All right, so just a bit on uncertainty, if I haven't already beaten this to death tonight, but uncertainty is risk, right? This is why we see the stock market going crazy up one day, crazy down the next day. It's because they just don't have enough data to really know what's happening, right? And risk is not a good thing, right? We spend a lot of time and money and effort mitigating risk. Not only is there a risk to your health, your family's health, but there's risk to your income, your family's income for an unknown period of time, right? There's a lot of unknown unknowns right now. It's really hard to make any kind of plan when you have unknown unknowns. So in that instance, you're really kind of in a financial damage control mindset, right? So you're looking to preserve funds where possible. This suspension is a rare opportunity to be able to do that with a major expense like a student loan payment, right? So take advantage of that. Do not give it up lightly, and don't continue making payments because you feel like you have to. File a tax return, right? Again, if you haven't, or check the limits on the income for when they're going to send out stimulus checks, you may be eligible for a stimulus check. Cutting those non-essential expenses, right? So this is where you're really going to want to get familiar with those things that you need, as opposed to those things that you want, right? You want to cut back to those things that you need, because you just don't know what's going to happen to your income. If your income hasn't been affected yet, save those monthly student loan payments, maybe in a separate account. And then prior to the end of suspension, if you come through this relatively unscathed financially, then you can reevaluate the best place to put those funds. Maybe there's your student loans, if you can get directly to the principal, maybe not, right? So in that case, I'm looking at a forgiveness plan, an emergency fund, maybe some other savings goal that I had in mind, right? So don't give it directly to your loan servicer just yet. What we do know about the transition, this is covered in the CARES Act as well, is in August, we're supposed to start receiving transition notices from our loan servicers, right? This is presuming that the suspension does end September 30th, as it is indicated in this current law. They do say that, quote, normal payment resumption will occur, whatever that means, right? So that was kind of what I alluded to earlier. Whatever you were using when the suspension took place is what you will be using during the transition. But then again, you may need to provide some income documentation to renew, or maybe your income situation is completely different and you're going to have to provide updated income information at that time. But there will be, or there's supposed to be, at least by law, a lot of communication between your loan servicer and you a month to 6 weeks before this suspension period is due to end. There's not supposed to be capitalization of your interest, right? But again, that kind of depends on the status you were in prior to suspension. If you were in a non-administrative forbearance before the suspension took place, then you're still in that forbearance, right? Which means that they may capitalize your interest when you come out of this. So that's why it's really important to kind of know what you were in as you're entering this suspension. That may also dictate whether or not you try to opt out of the suspension to try to get into a repayment plan before opting back into the suspension, if it made sense for you to do so. That's a lot. That's really complicated. That's probably something we should address individually if that meets your circumstances. They are supposed to count the suspension time towards forgiveness. Again, if you're in an income-driven repayment plan, or you're in some kind of rehabilitation or working towards public service loan forgiveness prior to the suspension taking place, then that time should count during that suspension. You can still enroll in income-driven repayment if you're not using it now, right? They will still process that. You just have to, pay attention closely and make sure you're answering all the right questions that they ask you, because there's probably going to be some questions about waiving the suspension to put you in repayment, and that may be appropriate to get yourself into an actual repayment plan, and then you can request to have the suspension reactivated. Stay tuned, follow closely. We've been putting some blog updates on VIN Foundation and the COVID-19 impact of student loans post that we've been maintaining. This is a hugely expanded version of that. But we're going to keep updating information there, and we'll post the recording to this video. And when we learn anything new that is different from what we reported tonight, we'll report that to you as well. I think it is going to take a little bit of time for this to work its way through the system, right? I'm sure the loan servicers are going to make some mistakes. I'm sure we've already made some mistakes, right? So you just have to be a little bit patient, ask a lot of questions, and work to get to where you're trying to be based on the information that we have available now. I have one last poll to close off this evening before we get deeper into the questions. And this has to do with what you're planning to do during this CARES Act suspension. Hopefully you guys can see that. Oh, I don't see any result. Now I do. Yeah, there's definitely a delay. While I'm waiting for you guys to complete that poll, I have a question here. I see I have two sets of loans, one set subsidized, one set unsubsidized. Does that mean they are federal loans? So subsidized and unsubsidized doesn't really tell you a whole lot in terms of the suspension. You can have unsubsidized and subsidized loans that are federally held, and you can also have non-federally held unsubsidized and subsidized loans. That just has to do with how they treated the interest while you were in school, right? So subsidized loans means they don't accrue interest while you're in school. Unsubsidized loans means they do, right? So you're still looking to see who the owner or holder of those student loans are in order to know whether or not they're eligible for the suspension. All right, let me end this poll. Share these results. All right, looks like hopefully the majority of you are going to leave that suspension in place, at least until you have a more clear picture of your finances and whether it makes sense to do so. So thanks for answering all of those polls. Jordan, are you able to see that one?
I am, but the way that Zoom's updated, it doesn't allow me to see all the answers in one screen, and you can't make it larger. So you sort of have to scroll a bit. So hopefully everybody's able to see it.
All right. So what did we miss, right? So these were some of the questions that you all submitted, right? So I think we covered the public service loan forgiveness while unemployment. Will only some payments qualify? It really depends on when you get back to work and when they look at the full year's worth of qualifying payments, if you meet that average of 30 hours per week. And who knows, they may even make some exceptions in further legislation depending on how long this impacts everybody. I can see them potentially doing that if lots and lots of people end up losing their job, and there's a clamoring for that, particularly for the folks that are working towards public service loan forgiveness. I think we've done a pretty good job of the payment suspension, good or bad. I mean, I look at this again as this is way more beneficial than I would have ever guessed, right? I mean, income-driven repayment was already really set up really well to handle something like this pandemic and mass decreases to income. Right? If you lost your income before and you're using an income-driven plan, you can submit to have the payment reduced all the way to zero, right? And now the government gave us the bonus too on top of that of having the interest not accrue and the time actually count as well. So that is a really, really huge benefit that they're offering in this legislation. Do I have to call my loan servicer to stop payments? You do not, right? This is going to happen automatically. It may not have happened automatically for your loans yet, but it will. Here, let's go back over to, I haven't logged into my Great Lakes account to show you what that looks like. So I'll take you over to my Great Lakes login, because that's where the bulk of my loans are. You can see the.
Somebody was asking, Tony, that you mentioned earlier about Great Lakes, and they asked if they sent you a letter about this information because they have not received anything.
No, I haven't received any letter or anything. So everything that I've done with them has been over the phone, right? And I was logging in every day and looking, and one day I saw that my loans are in forbearance, right? And then I was clicking on my account summary, right? And this is where, I mean, these are why the loan servicer portals drive me crazy. It's impossible to find anything easily. So let me go back. I think I even got lost here. Looking for here we go, account and loan details. This is what I was looking for every day, was this evidence of my 0% interest rate, right? So they physically set my interest rate to 0. So when I say interest suspended, they set the interest rate to 0, right? Which is great. And here's the loan status. And this is actually really helpful, right? So this is the part that was giving me heartburn, was that it slaps a forbearance label on my loans, which I don't like, right? But it is a special type of forbearance. And in this case, they are calling it a Coronavirus Pandemic National Emergency Act, which falls into the non-capitalizing forbearance options, right? So this actually provides me some pretty good certainty that my unpaid interest is not going to be capitalized when this suspension period ends, right? So a normal forbearance, a normal deferment, any interest that accrues on those types of loans that can accrue interest during those periods, your unpaid interest would get capitalized, right? But when there's special circumstances, and your loan servicers do have the discretion to do this, but the law provided it through the language of the suspension, this is a special type of forbearance, right? I prefer to call it a suspension, but again, they all call it a forbearance because that's how this stuff works in their world. So it's okay if you see the suspension that was automatically provided here. So this is, I wish they would put that language that I had to go navigate and find here. But when I saw this is why I was calling them. I'm like, look, you guys got to do a better job, right? I mean, you can't just call it a forbearance because this has some really negative connotations. But it does look like they are trying to work towards that. So give them some time. Hopefully, your loan servicers will have some language or something in here that provides a little bit more reassurance that there will be no capitalization after the end of this suspension. When do we have to re-sign up for income-driven repayment? Again, that's really going to depend on what the process is for unwinding all this, right? And where you were in the renewal time frame, and your loan servicer may want updated income documentation. I mean, I really don't know yet, right? That's something we're just going to have to wait and see. This was a good one. Somebody asked about, does this suspension hurt your credit? And in the law itself, it actually mentions that the Department of Education and your loan servicers will have to report to the credit agencies that your loans are still in good standing, right? So this is not going to hurt your credit in as much as a $0 payment kind of already does, right? So it's not going to hurt it, right? But if you're going to go try to make a major purchase, which again, unless absolutely necessary, probably during a pandemic is not the best time, it may be harder to do that when your credit report shows a $0 payment due on a student loan, a veterinary size student loan balance, right? So that may be an issue. Again, it's kind of too early to tell. And that's going to be a really unique case, right? So if any of you are in the home buying process right now and almost into the underwriting, and your lender raises a flag because of the suspension, email me and let me know, right? I'm happy to try to help you work through that. But I'd love to know if that's actually happening. Again, the law says it's not supposed to hurt your credit, but there's some logistical things there that can make it difficult when they report a $0 payment, even though you're in good standing. Sorry, didn't mean to do that. How to stop auto pay? You don't have to stop the auto pay. Again, that's going to be part of the automatic suspension, right? And if a payment was triggered, if it happened after March 13th, you can call up your loan servicer and request to have that refunded. You do have to call them. They won't do that automatically. So you will have to call and actually ask to have that payment refunded. Possible interest penalties for choosing one of the offered options. Again, as long as you are in repayment during the suspension, then I don't anticipate any capitalization of interest, right? But if you entered the suspension and you were in forbearance, when you entered, right, a non-administrative forbearance, then you may experience a capitalization of your interest if you don't change that during the suspension. All right, so this is a list of resources that you all can use, but let's dive into some of the questions here.
So one question that's been asked a couple of times is, where would you recommend putting the money that you're saving during this time?
Yeah, so great question. So the first thing I did was, you can use any website that's your favorite, but I like bankrate.com, or you can go to nerdwallet.com. Both of them have some pretty good, collection of material that can help you answer that pretty quickly. So if I go to the banking section here, I can look at who's offering the highest interest rates on savings accounts, right? I just monitor this just to see how interest rates too are impacting savings accounts nationally. But I would pick the highest earning online banking account that I can find. You can get 1.75% on some of these ones that are still offering that, right? So pick your favorite, set up a transfer to get those funds in there, and then you can even set up an automatic transfer of what you were paying your for your monthly student loan payment, and put that in the bank account and earn that 1.75%. Jordan, have you seen any other ones that were?
Yep. So a lot of people have questions about public service loan forgiveness.
Sure.
One was really popular was, I'm in the public service loan forgiveness program and would be interested in the interest waiver, but absolutely do not want to go into forbearance or suspension of payments. I absolutely do not want my auto pay turned off. I want to continue paying. How do I do that?
Yeah, I mean, you can opt out of the suspension and they will resume basically as it was before. However, that being said, this is a huge benefit to public service loan forgiveness as well, right? So public service loan forgiveness requires you to use an income-driven repayment plan. And the goal of public service loan forgiveness is to pay as little as possible and have as much forgiven as possible. If the payments under the income-driven repayment plans count and you're still working for the public service organization, then there's no danger of that not counting towards public service loan forgiveness. Again, it's laid out in the law, right? So it would be breaking the law for them to not count that under that circumstance. So I would encourage you to potentially rethink that, because you may be paying towards your loans that are ultimately going to get forgiven. So you're essentially wasting that money. And during a time like this, I would not want to be wasting any money, right? And student loan payments are too much as it is. So, making those payments when you don't have to is hurting yourself financially.
Great. Another one is, what happens if I would like to go back to school during this time?
Whew. Great question. I have no idea. Right. Most schools are on some kind of online only as it is. As long as you're enrolled more than half time, you should be eligible for student loans. I really don't know. I'm not really sure how to answer that question. So again, but if you're receiving or you already have federally held loans, the interest and any payments that you have due are suspended. So presumably that would also apply to any loans that you would receive while you're in school during this time.
So another one is, does it make sense to ask for a refund on a payment that was made in mid to late March? Will that affect my repayment forgiveness timeline?
So if the payment was made after March 13th, then you can request to have that payment refunded, and it still would not count against your suspension period or your qualifying payments towards income driven repayment, right? Because it's all captured in the suspension period language that says that whatever repayment plan you were using before, the period that you're in suspension also counts towards the forgiveness, any forgiveness that you may earn in the future. So as long as that payment was made after March 13th, you should be able to refund that without any issue.
Another public service loan forgiveness question. Any suggestion for getting PSLF payments to show up on a monthly statement? I have been auto withdrawal paying IBR for more than 4 years, but the number of PSLF eligible payments per the statements are still 0.
So in that case, I would submit what they call a public service loan forgiveness employment certification form. Right, so that employment certification form is kind of the official monitoring mechanism for qualifying PSLF payments, right? And once you do that, if your loan servicer is not Fed Loan Servicing, they will move your loans over to Fed Loan Servicing. They will process the number of qualifying payments you've made, and then as long as you continue to provide that employment certification documentation on a frequent basis, they will update that count towards your eligible public service loan forgiveness. And once you hit 120, that's when you can apply to have the remaining balance forgiven.
So we have a couple people that are not in the US. A few people were curious about this question. I'm living, working in Canada, but have US student loans. So my AGI is always 0. This means my student loan payments based on IDR plan are 0. The interest continues to compound, and my total student loans have increased substantially. I know Tony just said to pay minimum and plan for forgiveness, but given the situation, should I try and make payments towards the loans or wait and let it all be forgiven? I'm guessing there must be someone else in this situation as well. So about 3 people were curious about that.
Yeah, so that is a not uncommon situation, and we have worked through that on VIN in the student debt folder. So if you are in a situation that dictates that you do not have a payment due on your student loans, you're quite likely to hit forgiveness. And in that case, the most financially beneficial strategy is to pay the minimum and plan for the forgiveness. Now, the one thing that stands out to me in that question is you said that the interest is compounding. It should not be compounding. Right? You only accrue interest on the principal balance. It only compounds if you fail to provide the income documentation on time, or your loan servicer puts you into some non-administrative forbearance or deferment, right? Or you switch repayment plans, something like that, right? So your unpaid interest should not be compounding. It's a simple interest calculation. So make sure that your unpaid interest is not compounding, and that it's only being calculated off the principal, and that your principal balance is not growing. If it is, then for some reason you experienced a capitalization event, and you're going to want to find out why. But from this point forward, you should not have a capitalization event. If you provide your income documentation on time each year, the unpaid interest will stay as unpaid interest. And then once you meet the maximum repayment period, your remaining balance will be forgiven. You'll have to pay the federal taxable fraction of that, whatever tax bracket you fall into when that happens, and you want to be diligent about saving for that, right? So it doesn't make sense to pay anything towards the loan payment. It makes sense to start a dedicated forgiveness fund. And your tax amount is going to be quite high, right? Because you're not going to ever touch the principal or any of the interest, right? So you're going to have a honking amount forgiven. However, you're only going to have to pay the taxable fraction of that, right? So your goal is to be prepared to handle that taxable fraction. During the suspension, the interest doesn't accrue, right? You weren't making any payments before anyway, so the payment suspension really doesn't help much, but the interest not accruing helps a ton, right? Because that will reduce the amount that's ultimately forgiven at the end. You can run that through the student loan repayment simulator, right? So if you put your student balance in there and put 0 income for the duration of repayment, it'll show you how much you have expected to be forgiven, right? And then you can use the forgiveness planning module and start saving that amount per month rather than paying anything towards your student loans.
Okay, we have another question of a couple of people are curious if they have student loans that were taken out prior to 2010 that may or may not be qualifying for this most recent loan program. For instance, one person has one from 93 to 2001.
Yeah, so that's where I would go earlier when we went. Now, it was a long time ago that you borrowed student loans, you're going to have to come over to studentaid.gov and probably create an account, right? So you're going to have to reactivate that account that, back when however they distributed student loans back then, you're going to have to create an account that's going to allow you to then log into this system, this studentaid.gov, using your federal student aid, what was back then was called the PIN number, right? But once you're able to get into here, you'll be able to obtain your student aid data file, right? So this is the process we went through earlier. I'm going to click on view details in my dashboard. I'm going to look for this, download my student or my aid data file here, and that's going to generate that ugly looking text file that you can then upload into the VIN Foundation Student Debt Center. And this is going to show you your loan types and who owns them, right? So if I go back to mine, right, I have some of those older loans back in the 90s, right? That's what these are from, these FEL loans, right? So this will break that out for you. And you may even have direct loans. Direct loans were around back then, but they were randomly assigned, right? And back then, the predominant loan type was the FFEL, right? But since 2010, those have been discontinued. So now everybody has direct loans, right? But back then, it was kind of a crapshoot as to whether or not you had direct loans versus the federal family education loans. So obtain that student aid data file, upload it into the My Student Loans tool, and this will be the answer that you're looking for.
Great. So a couple of people have said that they have federal loans held by AES. When I contacted them, they said they weren't applicable to the CARES Act provisions because they are a private company. Is there anything I can do?
So it's not so much that I would want to know what those loan types are, right? So again, I'm gonna refer you back to the federal student aid website, so studentaid.gov. Retrieve this file, upload it into the My Student Loans tool, and identify that loan group that it is. What category of loans does it fall into? The fact that they reside with AES is not enough information, right? And that's why we really don't futz around with the servicer data much, because it's not consistent and reliable enough to actually make decisions with, right? So we go directly to the source, we get the data directly from the National Student Loan Data System, and we can actually answer those questions. Because I don't know if what your loan servicer told you is actually true or not, right? But if you put it into here and we see that I've got direct loans, or those loans with AES are actually Department of Ed / AES loans, then you can go back to them and say, yeah, they actually do, right? But they might be FEL program loans, and if they're FEL program loans, then you can consolidate them, right? But if they don't show up in your student aid data file at all, right? If you download this file or you don't have any data in there, then they're a private loan, right? Which means they are not covered by the CARES Act. And you're correct that there's really not any way to make them apply to that CARES Act unless AES is offering any special kind of payment or interest discount during this pandemic.
Okay, a couple of people have a question about Great Lakes. I have Great Lakes on IBR. They automatically put my loans in forbearance. However, it looks like when I am to resume payment in November, it looks like my monthly payments will be much higher. Does this mean I need to reapply for IBR?
Yeah, no, I asked them that same thing, right? So this is just a function of how they handle income-driven repayment. And again, is another reason why I hate actually dealing with any of the loan servicer portals. So let me go back out to mine. Mine says the same thing. right? My monthly payment says $1,975 will be due starting 7 months from now. None of that is accurate, right? This is just because they don't know what my payment's going to be at the end of the suspension. So they put in what the standard 10-year amount would be, right? They're just filling in a hole here, right? And if you call them and ask them about it, this is not actually going to happen because I have already provided my income documentation and they have that on file, and it will get updated once they force it to update, right? But they're not doing any of that right now because the suspension is in place. So this is just kind of a default placeholder. But I hate that they do that because this causes tons of confusion, right? So this is not going to be my payment. This is just, you know, based on some standard 10-year measure because they don't know what to put in there when you're using income-driven repayment.
Okay, another question is, if we choose not to make payments during the suspension but have IDR plans, would we then be setting ourselves up to have that much more time left before forgiveness? Or should we still be paying the minimum to count towards forgiveness, count towards it faster, like we'd be wasting the few months in suspension if they don't count it towards forgiveness?
They are going to count it towards forgiveness, right? That is spelled out in the law, right? So they are going to count it towards forgiveness. It will not require you to be in payment any longer, right? That's why it's so beneficial, is because it doesn't require you to be in repayment any longer. So, and it doesn't grow your balance anymore than it had been before the suspension. So, again, that's why it's so beneficial.
Okay. Does the no interest period apply if you're still in school and have not started paying on those loans? Should we start paying now if we're graduating in May?
Yeah, so the no interest has started and will have taken effect as of March 13th. However, it doesn't make any sense to make any payments because you're in that in-school status, right? So you will not be able to get out of that in-school status until you graduate and unless you consolidate and waive your grace period, right? So that's how you can actually get the clock ticking and get the payments to count during the suspension, is by consolidating your loans after graduation, waiving the grace period, so ending the grace period early, and choosing an income-driven repayment plan. And if you're anticipating hitting forgiveness in the future, then you're going to want to get that clock started as fast as possible, and even during the suspension, right? Because the suspension period will count towards forgiveness as long as your loans are in repayment. And that's where the gray zone is for the new graduates, right? And that's why the timing of this is suboptimal at best, right? I mean, the timing is not great for any purposes regarding this, but for new graduates, it really kind of puts a wrinkle in that ability or that strategy to try to get your loans into repayment as fast as possible, because it's just confusing. You still can, right? It doesn't interrupt any of those processes that allow you to do that. It's just mentally, it seems like it's causing a lot more confusion because the interest is not accruing, right? And that was predominantly why we were recommending that before. So, but now we're recommending it for the additional bonus that you're going to get the clock started during the suspension. But again, we're going to cover that in more detail during the webinar that's specific to new grads.
Okay, so I think that we will also cover if somebody's graduating in May of this year, should I use the forbearance time until September or end the grace period early and start making payments on loans once I start working?
Yeah, no, so if your debt to income ratio is going to be greater than 1 when you're graduating, then you want to file a tax return now, consolidate, waive the grace period, enter an income-driven repayment plan, right? And get the $0 payment for the first 12 months you're in repayment. You'll still be benefiting from the interest suspension, but the clock will start ticking towards forgiveness, right? You really want to get that clock ticking, and you want to get that 12-month period of $0 payments guaranteed.
Okay. I have the same question regarding payee versus repayee. Also, if we plan for forgiveness, but we are not sure if we qualify for forgiveness, then aren't we just allowing the interest to accrue and end up having higher loans?
Let me read that one.
It's the top one on the
Yeah.
questions.
So it sounds to me like this question is about uncertainty around whether or not you hit forgiveness. In that case, I would run simulations. So I'm going to take you back to the simulation that we ran earlier, right? So once you have your starting repayment balance, you know what your principal and interest is after you graduate, or maybe you're in repayment, right? And you're not sure if you're going to hit forgiveness. This is where using the simulator is going to help, right? If your debt to income ratio is greater than 2, I can tell you that it is quite likely that you're going to hit forgiveness, right? It is very difficult for you to pay your loans to 0 with a debt to income ratio greater than 2, particularly if you're using pay as you earn. It is quite likely that you're going to hit forgiveness. You can run that in the simulator yourself, but after running tens of thousands of these, that tends to be the case every time, right? So if you want, if you're kind of in that in between area where you think your income's going to increase greatly in the future and you're going to fall closer to that debt to income ratio 1 or less than 1 shortly into the repayment period, then put those numbers into the income information section and see when and if it actually comes out to be less expensive and has an amount forgiven of 0. Right? So it's, it really is more of a holistic view. So if you put your student loan balance in there, the repayment plans that you qualify for, the income that you anticipate earning in the future, you want to see, 1, am I going to hit forgiveness? But 2, what makes this the obvious choice is that this is going to be my least costly repayment option by a long shot, right? Almost $100,000 less than trying to pay it off any faster, right? So, and we come down here and we work our forgiveness plan into it, and it becomes even more beneficial, right? So you're looking to see, 1, do I hit forgiveness? And 2, what is the total cost of my loan, right? So, I mean, I want to pay as little as I can towards my loans. And I also want to know if I'm going to hit forgiveness so I can plan for it. But you look here too, in order for me to not hit forgiveness, look at how much more I have to pay, right? In this case, it's $3,000 more a month. I mean, that's probably not doable, right? So there's a lot of factors that go into this. Plug your best guess of your income and your family situation into the simulator. See what the differences are between monthly payments, amounts forgiven, and total costs. And I think you'll have the answer to that question.
Okay, a few years ago, I consolidated my health professionals loan with my other federal loans. Does this affect how the CARES Act works, or would they all be eligible since they're consolidated?
Yeah, great question. No, that was a great move, right? And that's one of the benefits of consolidating those loans too, if you have health professional student loans after you graduate, is because you take a loan that otherwise would not qualify for income-driven repayment or this suspension, and now you make it qualify. Right? That health professional student loan is now part of a direct consolidation loan, which is eligible for all of the stuff that we've been talking about. Income-driven repayment, the payment suspension, all of that good stuff, right? So that was a great move.
Okay, somebody's asking if Department of Education, is this the same as a Capita Education Finance Corporation? I'm going to go with no.
I don't believe so. I'm not familiar with a Capita Education. I'm guessing that's probably a private student loan lender, or it's one of the minor loan servicers for the Department of Education.
Okay, say you have a 300K in loans at 6.25 and have been in payee for 5 years. After the compounding interest over the remaining years in the program, I would expect the grand total to be around 700K. What happens to that balance at the end of payee?
Okay, so this has more to do with repayment, and again, I'm going to kind of defer you back over to the simulator, right? So, 1, the interest does not compound, right? So, interest in an income-driven repayment plan does not compound. If it's compounding, then something is wrong, right? So the interest accrues on the principal, right? That interest that you're not covering with your payment ends up in an unpaid interest bucket. That unpaid interest does not get added to the principal as long as everything is going right, right? So your unpaid interest will be separate from the principal and will not compound, right? But when you get to the end of the maximum repayment periods under pay as you earn, that's 20 years total. So if you're 5 years into repayment, then you've got 15 years left before you hit the end. And I don't remember the exact numbers. I mean, we can even, use this to illustrate. I'm trying to find it here. I think I lost it. I want to say it was something like, I think you said it was like 250, but you do want to find out how much you have in unpaid interest, right? So you don't want to lump it all together. You want to break out what is principal and what is interest when you're using the simulator. I do remember you said it was 6.25, right? So I don't know exactly how much of this is principal or interest. And if you're in repayment for 5 years already, we can account for that in repayment, but then you're going to have to put some income information in here, right? I don't know what your income is, right? You can plug that information in here. We can run the simulation. It's going to depend on whether you're married, how you file your taxes, how many kids you have. All of that's going to play into here, right? But we can see if I run this out, again, I just threw some numbers in here quickly. If I have 15 years left with $250,000 under pay as you earn, my amount forgiven is not going to be anywhere near $700,000, right? And I think that is from that flawed assumption that the interest compounds, and it doesn't, which is why these income-driven repayment plans are ridiculously beneficial, particularly when your debt exceeds your income, right? And it's because of how they work if you're doing everything the way that you're supposed to be doing, right? So in this instance, I have an amount forgiven that's $344,000, but it's 15 years from now. If I'm assuming a 30% tax rate on that, I'm going to need $100,000 roughly. So you asked what's going to happen when I hit forgiveness. 15 years from now, they're going to cancel $344,000 of your balance. You're going to have to report that on your income tax return, and whatever marginal income tax bracket you fall into when you submit that tax return for that year. Here we're assuming 30% just as an estimate. You're going to have to pay $103,000 to the IRS by April 15th of that tax year, right? And if you hadn't started saving at all for it, you would want to start allocating $450 a month into some kind of account that's returning, in this case, 3% per year for those 15 years, and you would have enough on hand to cover that forgiveness, right? And your total repayment costs, right, on a $250,000 remaining balance in this simulation is actually less than what your outstanding balance is, right? So this is, you really need to understand how this stuff works. Plug the numbers into this simulator, because that's a huge, if you're assuming that you're going to have a $700,000 balance, well, one, you're way overestimating, which I guess is better than underestimating. But you're going to pay a lot less than you think.
Okay, a couple people are wondering, what if the government changes their mind?
Yeah, what if the government changes their mind? I mean, again, these plans are in law, right? So your master promissory note, your contract that you signed when you took these loans out, have these income-driven plans described by law in them, right? And as we're seeing now, right, with this COVID outbreak, when on the rare instance that they ever make a change to loans that are already in repayment, they tend to be more beneficial, not less, right? So, I mean, it's hard for me to wrap my head around the logic that says that this Congress, think about that, this Congress passed what we have now in the CARES Act that turned off the interest on your student loans, turned off the payments through at least September, is going to come back around as people are knocking on the door of forgiveness and say, we're going to eliminate this and you have to pay all of your student loans in full right now, right? Like that doesn't even make sense to me, right? So if anything, they would make them more beneficial, but it takes some extenuating circumstances for them to do anything with student loans, right? So it is highly, highly unlikely that they would, quote, eliminate or throw it out or whatever the case is, when it's already in law that this is how this is supposed to happen, right? So anything is possible, but I put that on the probability scale of me getting hit by a bus when I walk out of my house, right? Any day that can happen, but it is quite unlikely. So I'm going to continue operating under the assumption that I'm not going to get hit by a bus.
Similarly, people are wondering if public service loan forgiveness is going to go away.
Same answer, right? Public service loan forgiveness is by law. If you're in repayment, they are not going to do away with that for those folks who are in repayment. The only danger of public service loan forgiveness being eliminated is for folks who haven't even entered school yet, right? They're, you know, if and when they ever would pass some legislation around what's going to happen for borrowers in the future, right? So when they re-up the Higher Education Act, they might eliminate public service loan forgiveness for people who haven't started borrowing yet. But again, you all who have started borrowing or who are in repayment have signed a contract, right? And public service loan forgiveness is in that contract. It is highly unlikely that they're going to rip up that contract.
So along those lines, people just want to clarify, does forbearance equal suspension?
The law says suspension. The loan servicers are applying forbearances because that's the logistical mechanism that they have, right? And as we showed with the Great Lakes portal, some of them are qualifying that to call it a coronavirus emergency response label, right? So the suspension is by law, which the suspension is not a forbearance. The forbearance is how the loan servicers are executing this. So again, the law spells it out fairly clearly to me, right? That if you're in repayment, the suspension counts as a payment. If I remain in repayment, there's never a reason for them to capitalize my interest, right? If they're counting the suspension as repayment, then there's no reason for them to capitalize it. The fact that they're calling this a non-capitalizing administrative forbearance on their back end is also assurance that there's not going to be any capitalization event from the suspension. But the law spells out that the payments are going to count towards forgiveness during the suspension, right? So that's pretty straightforward. So I'm not terribly worried about that.
Okay, a couple people are wondering, does the suspended payments impact the loan payoff date?
No, right? So the suspended payments, it depends. So if you are using an income-driven repayment, no. If you're using income-driven repayment and you hit forgiveness, you will still hit forgiveness the same time frame that you were going to hit forgiveness before the suspension happened. If you're using a traditional repayment plan, if you're not making any payment and your interest is zero and there's no payment due, you've essentially just kind of paused that time frame, right? So if you're on a standard 10-year plan and you had made 50 payments and you had 70 left to go, once the suspension ends, you will still have 70 left to go, but it'll still cost you the exact same amount because nothing changed.
Okay. Should I be concerned or call my loan officer NELNet if my loans are Department of Education, but under status it says forbearance versus pandemic?
No, you should not be. That to me indicates that you have received the automatic suspension. And like, I don't have access to a NELNet portal, but like I showed with my Great Lakes portal, that's exactly what my loans say. It says your loans are in forbearance, right? I did nothing. I've been calling them and asking them questions, but I have not requested them to do anything, right? This happened automatically. That means that NELNet is likely getting around to applying these payment and interest suspensions, right? So, but they are calling that a forbearance, and I would keep digging a little further, like we found in this Great Lakes portal. I can see that there's more detail around that in here for the loan status, right? Now, I'm not saying it has to say that. I'm saying that provides me a little bit more assurance that this is going to work exactly as we've been describing it.
Tony.
Yeah.
So I've bon busy answering 100 and something questions.
Thank you.
157 to be exact. So
wow.
So I'm half listening, but I just heard you say something about the 70 payments still being left. aren't I clear that during the suspension period, those count as payments?
That example was for a traditional repayment.
Okay, gotcha.
Right? So
You scared me. I was answering wrong.
No. So for income-driven repayment, if I was, using pay as you earn, so 240 monthly payments until you hit forgiveness. If I have 220 monthly payments left to go before I hit forgiveness under pay as you earn, this suspension period will count towards that.
Okay, so I've been answering it right. Thank you.
Yes, but if I'm using a traditional repayment plan, there's really no way to count the payment, right? Because you still have the same balance, and so it'll just resume, and it'll just go longer than it would 6 months longer than it was before.
Okay, I appreciate it.
Yep.
Just so all of you know, that was Dr. Paul Payan who was chiming in. So somebody asks, just to confirm, even if we don't make payments for income-based repayment, each month we don't pay until September counts, right?
Correct. As long as you were in income-driven repayment when the suspension started.
Okay. Will federal loans tell me what my new payment for income-based repayment will be come September once the CARES Act is over, or will I not find out until September?
No, you'll find out. So we're going to learn a lot this summer, right? So if the CARES Act, if the suspension ends as is laid out in the CARES Act, which is at the end of September right now, and there's no extension to it by subsequent legislation, then the loan servicers are going to start sending out information in August that says this is what we need during the transition period, right? Or this is what you need to do, or this is what we're going to do for you during the transition period. I don't know what any of that is going to be. The law just says that starting August 1st, assuming the suspension ends on September 30th, they have to contact you no less than 6 times, right? They actually say that in the law, right? So we will get more information from them starting in August, presuming there isn't more legislation that potentially extends this suspension if it's necessary.
Okay. So a couple people have asked this question, and I'm forwarding them to the IRS website just because we don't have, it seems like that's the best place to go, but they're asking if they should file a tax return this year. So someone asked, I'm a student. If I have filed a tax return every year up until this year, should I still try to file this year to get the stimulus check and apply for IDR? My family accountant has told me a few weeks ago not to file.
So if you have filed a tax return every year prior to this, if you have one on file from 2018, then you can use that too. You can
for the stimulus check.
For the stimulus check, and also for the income-driven repayment application, right? So the income-driven repayment application will accept a tax return as long as it's not more than 2 years old, right? So if you filed one in 2018, that would work too, right? But most folks, if they haven't filed one during their 4th year, they probably haven't filed one during their 3rd year either, right? But since you have, right, then it sounds like you would have one on file that you could use for both. Now, if your parents are still claiming you as a dependent, that may impact the stimulus check, right? So only if you're independent from your parents on their tax return might you receive a stimulus check if you have a recent tax return on file that's independent from your parents.
Okay, someone said my federal loan still shows my payment is due next week. Do I pay it, then ask for a refund, or just not pay it?
I would, next week is still a long time in pandemic time, right? So I would give that one a few days yet. If you have auto pay set up, you really don't have to worry about that, right? I wouldn't flirt with not making a payment that's due, right? If your loan servicer is not quite ready to have the payment suspended by then, I would set up the auto payment so it's due to go, right? And then request it back once they put my loans in the suspension, right? But I don't want to trigger anything that's going to put me into delinquency or anything. That shouldn't happen, but just out of the abundance of caution, I would handle it that way.
Okay. So my RBR amount is $1,700 a month. If I pay the minimum and put $500 in savings to save for forgiveness, I may as well pay the full amount of my loan, which I can't afford with 3 kids in daycare. What would my option be? Married, filing jointly, 3 kids cannot file separately because it negates all the deductibles and they end up owing.
Yeah, I mean, that's beyond what we can cover here, right? I mean, that would require really digging in. There's a lot of things in there uh, that don't make sense to me entirely. Um, if the amount that is due based on your combined incomes plus the forgiveness amount is equal to how much it would cost to pay the loans to zero, then something's not right there, right? So there's either the payment that they're calculating for your monthly payment based on your incomes is not right, or something is not right there. But we would want to handle that. That's where I would refer you over to the VIN student debt folder where we do some personalized help. You can post anonymously in there. If you're not a VIN member, we have some ways that we can handle that through VIN Foundation. So email me at studentdebt@vinfoundation.org, and we can dig a little deeper into that.
Okay, wonderful. I think there are some additional questions here. We're going to keep track of all those. As I mentioned before, everybody that registered for this webinar will receive a recording along with additional helpful information, all the links that Tony has up on the screen right now, along with additional ones. And if you have any questions, you can email studentdebt@vinfoundation.org. And we're here to help you. Anything that we can do. Tony, Paul, any other last minute words?
I don't. Just thank you. Thank you, Jordan, for moderating, and thanks, Paul and Matt, for answering all those questions behind the scenes, and thanks to everybody for attending and staying on top of this stuff, right? So keep asking questions. If it doesn't smell right, then there's probably ain't right? So email us. Keep asking those questions, and call your loan servicers. I don't necessarily trust everything they tell me, but if they disagree with what we're saying, then let us know, and we'll try to find out the answer and get it straightened out. For you. But stay tuned, right? Because this is evolving. So I hope we don't have to redo everything we just said here tonight anytime soon. But I think that small details will become more clear as time passes. So stay safe, stay healthy, stay tuned, take advantage of the flexibility, and let us know how we can help.
Thanks, everyone. We really appreciate you being here. And if you have any feedback, shoot us an email, go on the website, reach out to us on social media. Thank you so much, everybody. Have a good night.